Hey, good morning once again, options traders, and welcome back. And for the next few videos, I want to do a series on different perspectives on different strategies. And I think it's important because I've heard so many times traders think that a strategy works in a particular way, and when it doesn't go the way that they thought it would, then they think it's a bad strategy and say, oh, I'm never going to do that one again. And it's really the wrong approach. And so let's start with a very common strategy of the covered call and take a look at the perspectives that you should have before using this strategy. So let's go have a look at some of these perspectives. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is greatly appreciated. So first, the recap. Remember what a covered call is. You're going to buy 100 shares, or maybe you currently own 100 shares. Let's say they're trading for $100. Then you sell a call. Let's do the at the money. You sell the $100 call, and let's say it's trading for $5. Now, when you do this, you have the obligation to sell shares for that strike. It's actually the potential obligation because it's up to the person who bought the call to exercise it. Once you sell it, you have a limited maximum gain that is equal to the credit, in this example, $5, plus any potential capital gains. If you're selling an at-the-money option, you have no room for capital gains. But let's say that we had sold the 105 call instead. Now you could make another $5 from the stock moving from 100 to 105 plus the $5 credit. So that's what that means for the maximum gain of being the credit plus the capital gains. However, always remember you have unlimited downside risk, at least down to a stock price of 0, and that's because you still own the shares. Just because you have the obligation to sell if the price goes up doesn't mean you're really off the hook if the price goes down. So the best way to understand the covered call is that it is a neutral to slightly bullish outlook. You don't want to use this strategy if you are highly bullish. And so that's one of the bad perspectives right there. A lot of times traders will use a covered call because they like the idea of somebody paying them money right now credited to their account without thinking about that they have a potential obligation. Now, of course, yes, in exchange, we are going to get that $5 credit, at least the $5 credit for this example. But that's the way that we need to make our decision. What do we need? What are our goals? And is this going to help us meet our goals? So let's do that. Let's say that we own shares at 100 and we sell the $100 call for 5. If we do, this is our risk graph in black at expiration. The red curve is the current curve. So remember that the red curve starts to slowly work towards the black as time passes. So right here is the maximum gain, everything above that strike. And that's important to understand. That is the best you can do. In this example, $5. So if that's not sufficient for your strategies, well, you shouldn't do this one. And if you are choosing to do it, well, then obviously this was a good choice. And don't think that the stock has to come right up here to 100 and stop. It probably won't. It's probably going to be under it or over it. It's not going to be exactly at that strike, at least most likely. So that's also part of the perspective. Realize that probably half of the time you're going to be above this strike. So why would we do that? Well, if we look at the stock price at 100, that's our risk graph before we entered the covered call. And remember, there's always a bell curve over the current stock price. So the center of the curve is right here at 100, and we can see now some of the benefits of the covered call. Notice that this black line, this break even down here, where we cross 0, is shifted to the left of where it was when we just owned the stock. So our break-even point is lowered by the price of this covered call, the premium. So our break-even point is 95. And based on the bell curve, now we can see, can it fall below that break-even? Yes, but it's not nearly as likely as it is here for the red curve. There's a 50% chance that it's going to fall below there. But now we've sharply reduced the downside risk. We haven't eliminated it. We still have unlimited downside, but it's been reduced by the premium, or $5. So understand that when you're using this strategy, it's about giving up some of this upside. Notice that this red line the stock by itself, sits above the black. So we're willing to give that up in exchange for reducing the downside. We're just taking a little bit of the uncertain cash flows. In this case, we're taking $5 for sure in exchange for giving these up. And that $5 is serving to act as a little bit of a downside hedge. So if those numbers and those ratios work for you, by all means do it. If not, then it's not a good strategy. Maybe we could sell a longer dated one or a different strike. If we sell it in the money, we can shift this break-even point lower. If we sell it out of the money, we can raise the maximum gain higher. They are all trade-offs in risk and reward. But what's the perspective to have? Well, the first thing to understand with a covered call is that traders often see getting assigned as a risk. It's not really a risk, it's your maximum gain. It's the best the strategy could do. Yeah, it might be a regret, but that's looking in hindsight. We didn't know that at the time. We have to make the best decisions based on the current information. And if the current information said that that was a good deal at the time, then be happy with it. Live with it. That's got to be part of the perspective. Remember, you're never going to buy at the low or sell at the high. But with the covered call, traders seem to think that's the way that it works. And so if the stock rises, traders think that it's a bad strategy and they go, I got called out on my call. I'm never doing those stupid covered calls again. Well, it's not a bad strategy. It was just a bad outlook. And conversely, if the stock price falls, traders think it's a bad strategy and they go, I bought this stock and I never should have done that covered call because I was holding all of the downside risk. These are things you've got to come to terms with before you write the call. Now, another thing to understand is that if the stock price rises and you get assigned and you lose your shares, you can always buy the stock back. Nobody says that just because you lost it due to an option assignment that you can't get it back. That doesn't mean it was a bad strategy. And on the flip side, you can always sell it if the stock drops. Just because you're in a covered call today and the stock price drops doesn't mean that you're required to continue holding on to the stock and continue selling calls. That might have been your goal when you first put the strategy on, but remember that you're always free to change those decisions. So for example, let's take a look at the S&P 500. Here's the SPY. Let's say that you bought the ETF down here and you sold it here. You made a conscious decision to just sell those shares and they get sold and then the index does this. Are you upset with yourself? Well, you might be, but you could also look and say, well, it was a moment in time and I made that decision and I'm going to be fine living with it. But yet if that same selling point was due to an option strike being breached on a covered call and you lose the shares, everybody suddenly says that it's a bad idea. But if you think about it, at some point, if you were willing to sell it, why does it matter how it got sold? Whether you did it as a market order right now, or as a limit order ahead of time, or as a covered call. Selling the stock is selling the stock. It shouldn't make you hate the strategy just because somebody apparently stole those shares away from you due to an option assignment. It's just the sale of stock. And if you were fine selling the shares, in my example at 105 when you put the strategy on, it's no different than if you had set a limit order ahead of time and sold the shares. That's got to be part of your perspective with a covered call. So always remember that each day stands alone. You must make the best decisions based on current information. You're not required to let the short option dictate your decisions for a covered call. And mostly, remember that good decisions can have bad outcomes. So just because the stock might have been a little bit more bullish than you anticipated, that doesn't mean it was a bad strategy. It was more just that it was a bad outlook, and you can always get the shares back. So remember that when you're using the covered call, you have to have the right perspective. Why did you put it on? Are you okay with those reasons today? And if you are, then it's not such a bad deal to live with the outcomes. So the main thing to understand is that for any strategy, we can always alter it over time as things change. But for that, we have to understand what our hedges, rolls, and morphs can be. What other choices do we have? But the main thing that I want you to get from this video is make sure that if you're using covered calls, that you have the right perspective and you'll leave less room for regrets. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.